Hi everyone. Are global market shifts and the future of the US dollar weighing on your mind? You've worked hard for your wealth, and concerns about economic uncertainty are completely understandable. Many of our viewers, just like you, are looking for true peace of mind and lasting security. That's why tangible assets like physical gold and silver are becoming a crucial choice for wealth protection and legacy preservation. If you're thinking about how gold and silver could help safeguard your retirement, we invite you to take the next step. At ITM Trading, trusted for almost 30 years, we're here to provide clear, honest information. So take advantage of our free, no obligation consultation with one of our experienced analysts. It's a friendly conversation to explore your options, answer questions, and see if precious metals fits your goals. Call us or visit DannyReport.com to schedule your time. Everyone sees gold hitting new highs and thinks it's so expensive. But what if it's actually historically cheap? My guest today has analyzed the data from gold's secular peaks in 1980 and 2011 versus today, and he says the conclusion is unavoidable. Gold's price has not kept up with the very things that are supposed to drive it. So he's going to break it down for us today. Please welcome back to the show, Ronald Stoeferle. He's the managing partner and fund manager over at Incrementum AG. He's also the team behind that incredible report they put out every year that I can't wait to get my hands on, In Gold We Trust report, and we're going to get to that. But first and foremost, Ronnie, always good to be with you. Welcome back to the show.
It's a great pleasure, Daniela. Always good to see you.
I love how you state this. What if gold is actually cheap? You know, we're seeing it over $3,000. People are thinking, oh no, I can't afford it. But I love how you put it in context, right? First with money printing, you say since 1980, the gold price is up, 294%. US monetary base, over 3,500%. So the amount of money has expanded 12 times more than gold. I mean, it's crazy when you see the numbers, Ronnie.
Yeah, well, Daniela, I'm putting out that In Gold We Trust report now for 19 years. And since then, I think the first report was launched when gold was trading at 550, something like that. Since then, people keep telling me gold is too expensive. Now it's too late to buy gold. And for me, it's always important to regard gold as a monetary asset. And therefore, we have to compare it to monetary aggregates. And what we did in this report is we had a look at the so-called shadow gold price. We had a look at, the development of various monetary aggregates compared to the price of gold. And from a monetary point of view, gold is actually still extremely undervalued. I wouldn't say it's super dirt cheap anymore. Like, for example, in 2020, when we published the first In Gold We Trust report, where we said, okay, $4,800, that's our price target for the end of this decade. But we're now, I would say, at still reasonable price levels. So, for example, you mentioned compared to the 1980s or another secular all-time high in 2011. Since then, obviously, the price of gold is up. 1980, gold was trading at $850. 2011, gold was trading at 1900 at the secular peak. But since then, actually, the monetary base, for example, 1980 compared to the current level, is up more than 3,500%.
Yeah.
If you compare, for example, the M2 money supply to 2011, it's up 128%. If you compare the federal debt in 1980, it was 860 billion. Now we're at like 36 trillion. And that's only, the official debt. We're not talking about the unfunded liabilities. If you compare it to median house prices, for example, in 1980, you could buy a house for $63,000. Now the median house price is $416,000. So what I want to do with this table that we presented in the report, say, well, if we compare it to those secular highs, the final point of long-term bull markets, we're definitely far away from these price levels. So gold is in an established bull market. It's in an uptrend, but we're not close to the tops yet.
Wow. So talk to me a little bit about those tops that you see, Ronnie.
Well, I would say, Daniela, I think this bull market is basically it's based on a couple of different pillars. First of all, we're seeing very robust central bank demand. We had like 3 years, and we in football or in soccer language we talk about hat tricks. So we had a hat trick 3 years in a row, more than 1,000 tons of gold being purchased by central banks. And it's not only this what I would say kind of behind the curtains remonetization of gold. It's also the fact that the repatriation of gold is picking up momentum again. So this is a sign for the loss of trust that we're seeing in the international system. And obviously, Donald Trump was to large parts, to large degrees, responsible for this, this loss of trust in international, let's say, institutions and established things that we all got used to over the last decade. So there's kind of a bear market in trust, let's put it that way, on the international basis. Um, but then what's really excites me, Daniela, is the fact that things like a revaluation of gold, for example, or auditing Fort Knox. This was something
Yeah.
that we talked about, in our gold bug world, but now this is really becoming mainstream. Yeah, I
Yes,
think,
it's
gold is
true.
really becoming center stage now. However, if I talk to institutional clients, most of them say, well, we couldn't care less about it. It's already too expensive. We didn't participate in that bull market. It's too late. So that gives me a tremendous amount of confidence that, we will be climbing this wall of worry. That every major dip is being bought, and that's what we're seeing. Actually, we're seeing very, very shallow corrections, um, and that tells me that there's so much capital waiting on the sidelines, waiting to
Right.
enter this trade, that we're still, as I've said, far away from the top.
But it makes me think, Ronnie, what's it going to take for those institutional clients if they feel like, oh, well, we missed the boat. Why? What's the point of getting in now? What's going to be the impetus that's going to make them say, oh, we better get in?
Well, to some degree, it's FOMO, fear of missing out. Then I would say it's also the fact that inflation could stage a comeback. I don't think that inflation is dead. I actually think that we will continue to see high inflation volatility, and therefore another wave of inflation could become a trigger for gold going forward. And then obviously, it's pretty clear that what we call performance gold, and that was really the core topic of this year's In Gold We Trust report. It was called the Big Long. And that actually means that now it's time for performance gold, being silver, mining stocks, and also commodities. Because in this part of the cycle, that's really when those kind of levered assets on gold or levered plays on gold really pick up momentum and finally start outperforming gold. And as we've seen with silver recently, it can get pretty interesting very, very quickly.
Why do you think or are confident that we haven't seen the last of inflation? It's going to come back to haunt us.
Well, actually, because every central banker kind of keeps telling us that inflation um, was being killed. Nobody is really expecting another wave of inflation at the moment. Then, on the other hand, I would say that my friend Larry Lepard, he wrote a great book called The Big Print. We shouldn't
Yes.
underestimate the fact that monetary growth was actually um, quite low over the last couple of years. So we might see a monetary growth picking up momentum again. And then obviously, inflation also to some degree has a, let's say, a psychological factor. And I think that we all got really used to the fact that inflation is pretty stubborn, that it's sticky. Um, and I think that, talking to business owners, talking to investors, talking to just normal people buying stuff. We all got so used to inflation, and I think therefore that this inflationary chapter that we started basically in 2021, I think it's not over yet. And obviously, especially the ECB already lowered very aggressively. So from my point of view, that they painted themselves into a corner if inflation should stage a comeback.
Good point. I want to highlight some things from the In Gold We Trust report, because I remember when I interviewed you last year, I believe, um, it was centered around the new gold playbook, right? And the role that Asia was playing, and we obviously see the central bank buying coming out of China. Um, this year, you added, we still have this new gold playbook, but add on to it now um, the Trump card, right? What has happened with Trump and the tariffs, et cetera. It's now bolstered. Talk to me how you've seen this new gold playbook expand, what you found.
Well, I would say that the new gold playbook is still, it's still valid, and it's a point um, that I'm really emphasizing because I'm traveling quite a lot, not only business wise but also privately, and wherever I go to, especially in emerging markets. I've been to the FMF conference in January in Saudi Arabia, and you can really tell that gold for people in emerging markets in the Arabic world, in China and in India, has a clearly different appeal compared to the Western world. And if we have a look at the numbers, obviously it's not only central banks from emerging markets, but also private individuals being responsible for the majority of the gold demand. Let's say roughly 2/3 of the gold demand is nowadays coming from emerging markets. So I think that's basically this kind of love trade that I think Frank Holmes he coined this term. And I think it's important in our world to make a positive case for gold and not only this gloom and doom, everything will go to hell
Right.
case. So we're seeing very steady growth in physical demand from emerging markets. Now, what has changed over the last 12 months is actually the fact that now, very late, but finally, Western financial investors are starting to realize, well, actually, perhaps we should have some gold in our portfolio. So only starting in the second half of 2024, we've seen some modest inflows into the gold ETFs. Um, and there we continue to see inflows into the ETFs in the Western world, but it's still, I would say, fairly muted. There was a survey from UBS where they said the average family office, so those ultra high net worth individuals, they have currently allocated 2% in precious metals. So from my point of view, there will be, or there is, a bull market in sound money assets. And let's face it, it's not only gold that is trading very close to all-time highs, but also Bitcoin. So I would say that gold is some sort of a mirror of our monetary world. It's a mirror of our society. And what this mirror is telling us is actually we're seeing a very broad devaluation of fiat money versus hard assets.
Hmm. Talk to me about July 1st, 2025. I'm happy you bring this up and clarify this. You say tier one and level one HQLA, high quality liquid assets, live in different parts of the Basel rule book. Talk to me about what really, if anything, will change come July 1st for gold in the United States. Ronnie.
So Daniela, we put out an article on LinkedIn where we basically summarize the findings from all those topics: tier one capital, HQLA, tier one asset, and I think there's quite a lot of misunderstanding, and it's also to some degree it's very technical. Um, from my point of view, and talking to lots of people in the financial service industry, talking to central bankers, talking to organizations, talking to big bullion dealers, Actually, I wouldn't expect too much. I think it's going to be kind of a no event, because if you talk to bankers, I'm sorry, they couldn't care less about gold. For them, it's just, a useless shiny metal that's just sitting around. For a bank balance sheet, it's nothing that really makes the guys at the trading desks at the asset liability management, that really attracts them. So from my point of view, again, I think it's going to be a no event. But what's much more interesting, Daniela, is the fact that
Yep.
there's, the CEO of StoneX said that there were more than 2,000 tons of gold, physical gold, being imported into the United States over the last couple of months. Now, who's actually buying that? Is it institutional players? Is it high net worth individuals? Or perhaps it's even the US government? Actually, there were some very, very interesting pieces by Michael McNair saying, well, there's no reason to be, or there's, from a legal point of view, the US could actually buy and sell gold anytime. So perhaps, what's going on behind the curtains with this Mar-a-Lago Accord. um I think that I'm not sure if gold will play the, how do you say, the leading role, but I think it will play a role in that movie. And if we connect the dots, it's not only this pretty large amounts of imports into the United States, it's also the fact that, as I've said before, we're talking about a revaluation of US gold from $42 to current prices or even higher. We're talking about auditing Fort Knox, and Scott Bessent. He was trading alongside Stanley Druckenmiller, and he worked for George Soros. He said, well, actually, something big is coming, and he wants to be a part of
Yep.
that administration for
Yep.
some sort of a new Bretton Woods agreement. And he also says that gold is by far his largest private position, and that he's pretty bullish on that. So I think that makes me much more confident, compared to those, let's say, very technical things around Basel, where, from my understanding, it's not going to really have a major impact
Yep.
on gold demand.
Very, very well explained. And fun fact, Scott Bessent also interned, I don't know if you know this, Ronnie, for Jim Rogers.
I
So
didn't
he
know that.
has a long history. Yeah. So he has I think when he was like very, very young, maybe his first internship. But he has obviously a long history around gold bugs. Ronnie, final question: was there anything in your research this year in putting together the report that really surprised you or stuck out?
Well, there's 450 pages of research. Um, so there's like lots of numbers, and just crunching the numbers for mining companies, becoming like free cash flow monsters, and still nobody cares about them. Large producers
Yep.
having like margins of more than $2,000 per produced ounce, and
Yep.
having paid down their debt over the last couple of years. But then also, this fundamental um setup that we're seeing in the silver space, and as we touched before, I think that silver is now really, we've been talking about silver for ages, and it's a little bit similar. We're running one uranium fund, and my partner Christian, he always said, the fundamental, the supply demand case is so obvious, but the uranium price just really didn't move. And then at some point, we hit the trigger, and momentum kicked in, and it became a topic. And now I think we're seeing something similar
Interesting.
with in the silver space. But Daniela,
Well,
I think one thing that is really important is, I think that Donald Trump, he's addressing very important things, especially, the Triffin dilemma, that we've been very vocal about. Now, he wants to, and that's obvious, that's squaring the circle. He wants to protect this exorbitant privilege that the United States has, and at the same time, he wants to, you know, establish some sort of a reindustrialization of the United States manufacturing base. I think, what is most obvious to me over the next couple of months and quarters, and that's the most obvious trade, and you can have like various degrees of risk and kind of derivatives on that trade. But my biggest conviction is actually that we're gonna see a huge bear market in the US dollar. I think Donald Trump is very vocal about that. He wants and he needs significantly weaker United US dollar. I'm not sure if that's gonna solve the issues. If you have a look, if a weak currency would be the perfect recipe to prop up the economy, then Zimbabwe would probably be one of the most successful countries, and not Switzerland with a traditionally very, very strong currency. But I think that Trump wants and needs a very weak US dollar. Now, coming back to our initial topic, comparing the current gold price to secular all-time highs, what really stood out for me was the fact that actually, we've seen those tops in 1980 and in 2011, the US dollar index was trading at significantly lower levels. So in 1980, it was trading at 86. And in 2011, the dollar index was trading at 75. Now we're trading at roughly 99. So I think that in this next leg of the bull market for gold, and also probably mining stocks and especially silver, will be driven by a secular bear market in the US dollar.
Point made. Ronnie, it's always good catching up with you. Thank you so much for joining us.
Thank you, Daniela. And the next time you're coming over to Europe, let me know, and I will do the foodie tour in
I
Vienna.
can't wait. One of my favorite cities in the entire world. Absolutely love Vienna and can't wait to be back. And you said Larry's joining you soon, right? Our friend Lawrence Lepard.
Absolutely. I did
Wow,
the tour
that's
for
going to be fun.
so many people from the golf industry already. So I'm pretty.
It's a good side business for you,
Yeah, I
but you
could
do it.
also work as a tourist guide for gold bars.
There you go. Who would have thought? Nice niche business. Ronnie, thank you so much. And thank you all for watching. We'll have more great content coming your way. Be sure to stay tuned to the Daniela Cambone Show. And speaking of reports, we put all our free reports at a centralized location right now. I'm so excited by it. Go to DannyReport.com. They're all there. They're all free. Whether you're starting your gold and silver journey, you're midway through, or your experience, there are materials for all levels. So check it out. That's it for me. We'll see you soon.